everyone, a very good evening. You're watching The Money Show on ET now as a part of our Rise with India Prime Time segment. I'm Ubina Kapasi, and as always, this edition of the show as well will be dedicated to your money and answering any questions or queries you may be having on your financial portfolio. Here's what we have lined up today on the show. Once again, we've received a big hit for telecom companies, Vodafone Idea especially. Now, the question is, does your mutual fund have an exposure to Vodafone Idea? And if yes, what should you be doing with those funds? Also, we get the question, how closely should you be actually looking at the individual investments that your mutual fund does? That's what we'll be talking about today with Harsh Roongta, followed by Dhirendra Kumar's top fund recommendations. Also, the coronavirus outbreak still does not show any signs of waning off. Now the question that may be on your mind, how should you manage your travel? Should you travel, well, definitely not China, but should you travel to the Southeast Asian countries in the next 1 month? And what's the possibility of you being able to get a refund for any pre-planned travel? We'll be talking about all of that in today's episode of The Money Show. Folks, keep your questions and queries ready. But I think the big news flow that's been coming in has been coming in from telecom companies. The Supreme Court, of course, has wrapped the knuckles of the DOT of telecom companies as well as to why that order to pay up that hefty AGR due has not essentially been adhered to. Now, you may be wondering, of course, that why does it matter to me as an individual investor? Well, it does, especially if the mutual funds that you all have invested in have in turn invested in Vodafone Idea. Look at the AGR due that the DOT is asking for 53,000 crore rupees. Now, when the Supreme Court said that, look, the telecom companies have to pay up this AGR amount, we did see Vodafone Idea's share price tank to just 4 rupees. Currently, the share price is worth just 3 rupees per share. So there's obviously been massive erosion in the value of the share. So naturally, any equity mutual fund that has a big amount in Vodafone Idea has seen a big problem in their NAVs. And even the debt side, the papers as well that may have been issued by Vodafone Idea have seen a big fall. The net debt of Vodafone Idea is more than 1 lakh crore rupees. I'm not saying Bharti Airtel so much because many believe that if Vodafone Idea goes out of the race, Airtel will stand to benefit. But just imagine what will happen if Vodafone Idea goes out of the race, right? I mean, not only will you guys be languishing in the dark without having perhaps a network and a carrier, but your mutual funds as well will see a significant erosion in their NAVs. By the way, these are some of the mutual funds with exposure to Vodafone Idea. These are just AMC names, of course. Within that, you'll have to look for your scheme. There are several schemes, and we possibly will run out of space on our televisions to look to list down all those schemes. But yeah, Franklin Templeton, UTI, Aditya Birla, Nippon India. These guys do have a good amount of exposure to Vodafone Idea papers. That's essentially the debt side. Some of them do have it on the equity side as well. So let's understand then what's the implication of this. What should you do with your mutual fund? We have with us Harsh Roongta joining in, on this episode of The Money Show. Harsh, always a pleasure having you with us on the episodes of TMS. How big would something like this be for the mutual fund industry? I mean, Vodafone Idea is saying that, look, we are going to try and part pay that AGR debt and the AGR due. But God alone knows, and they themselves know whether operationally Vodafone Idea will hold out. In such a scenario, if my mutual fund has a large amount exposed to Vodafone Idea, what should I do?
So I think first things first. I mean, I think the most concentration of discussions around any default takes place in the debt mutual funds side. Obviously, there are also equity mutual funds would have had an exposure, and to the extent the price goes down daily, that price would have gone down. The reason debt is discussed so much is that debt goes down suddenly. That is the issue with debt, right? One day everything is going along fine and your debt is priced at the normal par value. Suddenly a problem occurs or a downgrade happens and you will see a big drop. If a default happens, the drop will be even larger, so much as that it can sometimes get segregated and put in a different fund, which is what has happened, say, with a Vodafone. I think the issue really is that in terms of debt mutual funds, historically people have been told that it is very safe. And normally it should be safe, but I mean, like the tagline of mutual fund says that all mutual funds carry market risk. So I think these are risks that everybody carries, and one should be conscious of the risk that one carries. So I think in the quest for higher returns, the the risk also increases. I think that is something as investors, all of us are becoming aware of. I mean, advisors were already aware of that, but I think this is a reminder of that fact that when you look for an extra return, it comes with an extra risk. But the biggest advantage of mutual funds is that it diversifies your risk across many holdings. And if one holding is not overweight, for example, if one holding is say only 2%, even if it goes completely bad, okay, you would lose obviously, but you would not lose money. You would basically have a lower return. And I think that is the advantage you get by investing in debt through a mutual fund. And there, of course, you should take your risk consciously. I think that is the key thing. If you don't really want risk, don't go for that extra bit of return. Stick to liquid funds, stick to overnight funds, uh, stick to things like arbitrage funds. Where if you have a high tax rate, then an arbitrage fund makes sense because it has very low credit risk, but it will give you a good post-tax return. That is something you can definitely do. If you don't have a high tax rate, then why not stick to good old bank fixed deposits? I think that is another thing that people should remember, that it is basically tax unfriendly. Otherwise, bank fixed deposits are not a good bank's fixed deposits. I meant the larger banks, the public sector banks, those banks you should look at. Also, you should, for senior citizens, I think their first port of call should be the 15 lakh limit that you have on senior citizen savings schemes and the PM Vay Vandana Yojana. That is assuming that, those are completely safe. They give you a good return, taxable return, but excellent 8% plus returns. But the key issue with that is you cannot withdraw capital. So to the extent that you don't have to withdraw capital, you just want to live on the interest, you must utilize the limit, that if you're a senior citizen, you must utilize the 15 lakh limit of senior citizen savings scheme and the 15 lakh limit of PMY Vandana Yojana.
Okay, I like how you mentioned big fixed deposit because yes, we have seen smaller banks also create problems for a lot of investors. The most specific case, of course, being that of PMC Bank, unfortunately, whose depositors are still grappling in the dark. It's quite a sorry state of affairs. Okay, but Harsh, like I mentioned, this Vodafone Idea thing is not the first. We've seen DHFL, we've seen ILNFS, and both of these cases have caused NAVs to plummet quite significantly. That's what my next question is going to be. When an investor puts money in a mutual fund, when he or she selects that, okay, I'm going to select this particular mutual fund, I'm going to put my money there, how closely should they actually be looking at which companies has this mutual fund invested in? Because, I think then that just defeats the whole purpose, right? You invest in a mutual fund because you don't have that much knowledge, and then there are such cases which really cause significant wealth erosion. So what should an individual do in such a case?
So, as I said, before putting in the money, be clear what risk you take your risks consciously. Okay. The point is that when you are putting money in a fund that invests in less than less than the top grade debt, uh, then there is always a chance that you will have a loss. So do that consciously. In fact, in India today, frankly, the difference between the returns that you get in a credit risk fund and say a banking and PSU debt fund, which is I won't say risk free, but relatively low risk fund, the difference, say that is about in net yield, the difference would be about 1.5%, 2%. Think think about it. Do you really want to take that additional risk for a 1.5%? I'm talking of a lay investor. I'm not talking corporate treasury. I'm not talking those kind of people. For a lay investor, does it make sense for him to take credit risks at all in the debt side? Because if he really wants that extra bit of return, I think he should basically look at, putting in a dash of equity, which over long run will give him a decentish return. Uh, if you talk about whether an investor can actually keep monitoring the mutual funds, I doubt it is possible for a lay investor to monitor. In fact, advisors find it very difficult to monitor. And this is not the last instance of a debt not doing well. We will see more instances. This is part and parcel of the industry. So I think you just need to be careful while putting in the fund. Post that, I think once you have taken a risk, if you've chosen to take a risk and put it in a credit risk fund or a income fund which may have some exposure to these kind of papers, then this you should stick to more diversified, where not more than 2% is in a single paper. Now I did a quick search, I could not find a single scheme where the top holding was less than 2%. So that is the reason why I said that today at least, taking debt exposure and taking risk on a debt exposure, anything other than a liquid fund or an overnight fund or a banking PSU debt fund or an arbitrage fund, today maybe it does not make sense, because the additional kicker that you are getting is probably not worth the trouble.
Okay, excellent. So keep your objective very clear as to why you're essentially investing, and then accordingly take a decision. You know what? I'm also going to open up our phone lines for any questions or queries as well. If you may be having any, you're most and more than welcome, in fact, to call us on the number appearing on the top of your screens, 24990300. That's where you can call in and get your portfolio as well verified. Okay. Mr. Roongta, before I just take on board all of those phonos and those email questions and queries, I just want to get in your view on, at this juncture, seeing how the markets are shaping up, seeing how the whole coronavirus bit is essentially panning out. We've been getting a lot of queries from our viewers, and then of course you have Vodafone Idea as well. So we've been getting this very interesting query from our viewers that, and this is quite common, they're literally telling us, should we just move out of the market and put our money in gold, because gold seems to be the only thing that is rallying. So Mr. Roongta, how would you like to respond to that?
My response is the standard one. I think trying to time the market when your objective is long term. So I think objective led investing is the way it should be. And when you do objective led investing, even a very major event like coronavirus, and it could become much more major and significant than it is today. I think in India, we probably still are it is still not top of our consciousness today. It probably could be larger. Then events like this are essentially events to rebalance, not really to do anything else. But your asset allocation, which means how much equity, how much debt, how much gold, how much real estate, that I think you ought to have decided in advance. And if equities go down, they haven't really gone down because of the virus. But if they do go down, or then probably it's time to load more of them, or if they've gone up, then you probably get out of it. I would not try to time the market when the main thing that you are doing is investment objectives, because I think, again, my views are basically for the lay investor, his ability to be to be tactical and take advantage. More times, I mean, more than 50% of the time he would lose rather than gain. So I don't think he should try to be tactical. That's my advice.